Hi, folks. I'm Mike Zlotnik, Big Mike, and today's discussion is going to be how high interest rates impact investments in stocks, commodities, energy, precious metals, and what does it do to real estate too. We'll cover that before we dive into that, the usual disclaimer: this is for informational, educational purposes only. No solicitation or advice of any kind. If you're interested in a family of funds or syndications, request PPM, private placement memorandum to accredited investors only. Consult with your attorney and CPA professional before making any investment decisions. All right, so let's dive into high interest rates environment. So again, just a quick summary of what has transpired recently. The long maturity bonds, typically 10-year treasuries, 30-year treasuries, have gone up a lot faster than the short duration treasuries, such as 6 months, 1 year, 2 years. So what does it mean? Why? You could certainly argue that the US budget deficits continue to be persistent and folks have been more and more concerned about them. Can also argue that we're dealing with dysfunctional government, with the Speaker of the House being ousted. There's all kinds of reasons that could have triggered that. There's also a possibility that the inverted yield curve is uninverting, which is an interesting possibility. So we've had an inverted yield curve, and the inverted yield curve simply means that the yields on long duration maturities are lower than the yields on short duration maturities. We've seen that. And that was signaling a recession ahead. Now the yield curve has flattened, or inverted yield curve has flattened, or it's flattening further, and it may uninvert. It's a possibility. The short duration maturities are a function of Fed funds rate and what Fed does, or has done over the last year and a half and continues to do. The long duration maturities, like 10-year treasury or 30-year treasury, very much depend on the market sentiment, the demand, supply demand of the treasuries. So it's very possible that the US government has been selling more treasuries, and the appetite for these treasuries have been softening as long-term expectation of inflation could be higher or could be geopolitical. Maybe China wants to give us a hard time. We don't know that. I'm speculating. I don't know the market forces. I'm just using an example. Maybe other countries don't like the United States. Some love us, some dislike us. So it's very possible that the demand for long duration treasuries have been softening. As a result, yields have been rising. Right. So we just don't know what is exactly have been driving these yields, but they have been going up. That we do know. So the basic substitution effect theory tells us that the demand for stocks and commodities should be weakening as a result of high yields in treasuries. That's the general rule of thumb. Why? Well, if you can park your cash in treasuries, both short duration and long duration, you can get pretty strong yield there. Stocks and commodities look less attractive. In fact, just to be clear, on commodities side, there are a few different commodities. There's energy commodities, oil and gas. They are notoriously a lot more volatile because they are a function of supply and demand, depending on the cold or warm winter and summer conditions. A lot depends on those circumstances. Also, it depends on production of energy by some oil producing countries and so on and so forth, and gas producing countries. So energy is a lot more volatile, driven by the forces outside of simple market economics. But that aside, leave just that what happens with production aside, the price or the attractiveness of energy as a commodity falls when the interest rates climb. Similarly, all other commodities, from both agricultural commodities to metal commodities to timber, they all, in theory, are less attractive as an investment versus keeping your cash in treasuries. Same thing is true for stocks. Investment in stocks obviously has higher degree of risk than the bonds. When the bonds pay higher yield, why go into stocks? Pretty basic and common sense. So that's the general market forces. As far as where the stocks can do better or worse depends on many other factors. Investors believe that we're dealing with accelerated inflation and companies have pricing power and they can increase their revenues as a result of inflation and be able to increase dividends and incomes, then the stocks could go up. But as a substitution effect, all other things being equal, when yields on bonds rise, stocks become less attractive, commodities become less attractive, including precious metals. So I have a separate video recorded on the precious metals, but it's pretty simple. Precious metals don't reproduce. They don't produce any dividend. They don't pay. Exception is, of course, if you have a gold producing company, if this business is good, it could pay dividends, but that's very different. Not owning gold producing company, not a gold producer, but more of a commodity gold. It doesn't reproduce, it doesn't pay dividends. And if the cash can be parked in alternative investments, such as treasuries, precious metals look less attractive. So we covered these topics. And how does that all compare to real estate? So real estate, and just to be very clear, when I say real estate, I mean both real estate equities and real estate debt. If you're a lender or if you invest in real estate loans that you can originate, and you can now get higher interest rates on your originated, on your deployed cash, you're feeling better. So the fact that the interest rates have risen creates opportunities to ask for a higher yield on your investment in essentially real estate backed bonds. So that's it. The opportunity to invest becomes more attractive as yields have gone up. And when we originate hard money loans or we invest from our income focused funds, we generally demand higher rates because the interest rates have risen. It's an opportunity for us to generate higher yield and be a little bit more conservative in our underwriting. So as a lender, and we do plenty of loans, we love high interest rate environment. But as an equity participant, when we invest in equity of deals, when we're dealing with the higher interest rates, the 10-year treasury typically drives the mortgage rates. So most of the mortgage rates on both residential and commercial are very much tied, fixed rate mortgages, to the 10-year treasury. So the mortgage cost of debt, cost of interest, goes up with interest rates increases. So investment in equity looks less attractive, all things being equal. However, as an equity investor, we demand better pricing. So when we invest in those deals, we would like to buy deeper, steeper discounts. We need motivated sellers. And that's what happens. So investing in equity becomes a lot more careful. You don't invest on a momentum basis. You invest when you see motivated sellers that need to sell for whatever circumstances that they're facing. So investing in debt enjoys better yields, but investing in equity requires more patience, requires more care, better underwriting, and buying deeper. That's the best way to think about the real estate strategies in these higher interest rate environment. So appreciate your time and attention. I hope this in stocks, commodities, energy, precious metals, as well as real estate investment opportunities. Appreciate your time and attention. Until the next time. Thank you.